The dollar just got replaced. Now hold on, that's a heck of a headline, and if you're skeptical, you should be. This isn't a story about an overnight coup or a dramatic financial collapse. It's quieter, more complex, and frankly, a lot more interesting. While there wasn't a single press conference where Canada announced it was dropping the dollar, the trend is unmistakable. Quiet, directional data and a series of strategic moves tell a fascinating story about where global finance is really heading. This wasn't a sudden attack on the dollar. It's a pivot, a deliberate maneuver, executed by one of America's closest allies. So, how is Canada preparing for a world less dependent on the US dollar? What are the concrete steps being taken to diversify its trade, and what is this digital loonie technology that could make it all happen? In this video, we're going to follow the money, connect the dots, and uncover the real story that almost no one is talking about. If you want to understand the tectonic shifts moving the global economy beyond the headlines, make sure you subscribe. We're going deep on this one. To really get what's happening, you first need to understand the world we all live in. It's a world fundamentally built on the US dollar. For the better part of a century, the greenback hasn't just been America's currency, it's been the world's currency. It's the bedrock of global trade, the benchmark for oil and other vital commodities, and the asset everyone runs to in a crisis. This system wasn't an accident, it was designed. In 1944, with World War II winding down, leaders from 44 nations met at Bretton Woods and pegged the world's currencies to the US dollar, which was itself backed by gold. Just like that, the dollar was crowned king. But in 1971, President Nixon severed the dollar's link to gold. Many predicted its reign was over. They were wrong. What rose from the ashes was arguably even more powerful: the petrodollar system. Through deals with oil-producing nations, the U.S. ensured that the world's most critical commodity would be priced and traded almost exclusively in dollars. If you needed oil, you had to buy dollars first, creating a massive, unending artificial demand for the currency. This setup gave the United States what's famously been called an exorbitant privilege. America could essentially print money to pay its bills and run huge deficits without the same consequences other countries would face. More than just an economic edge, this system morphed into a geopolitical weapon. Since most international payments have to pass through U.S. banks, Washington gained incredible power to monitor and control global finance. We see this power in the use of sanctions, which can effectively disconnect a country from the world economy. For decades, the world mostly went along with it. The stability of the system seemed worth the price. But recently, something has changed. The very weaponization that makes the dollar so potent is now pushing nations to look for an exit. Countries all over the globe, from rivals to friends, are starting to ask the same risky question: what if we're next? This is the great agitation of our time, the start of a global trend called de-dollarization. We see it most clearly with the BRICS nations: Brazil, Russia, India, China, and South Africa, which are actively building systems to trade in their own local currencies. And it's in this environment, this world of shifting alliances and growing risk, that America's quiet northern neighbor is making some calculated moves. Canada isn't a BRICS nation. It's a G7 ally and one of America's biggest trading partners. And that's exactly what makes its actions so important to watch. While the world was watching the BRICS nations, Canada was quietly laying the groundwork for its own financial recalibration. This isn't some aggressive anti-American gesture. Think of it as a defensive strategy, a quiet pivot born from a simple realization: in a new era of global competition, being totally dependent on the US dollar is less of an asset and more of a vulnerability. A major catalyst for this rethink is the growing unpredictability from its southern neighbor. The aggressive use of tariffs and threats to existing trade pacts have forced Ottawa to reconsider old assumptions. With the mandatory review of the Canada-US-Mexico Agreement, or CUSMA, happening in 2026, the threat of renewed American protectionism is very real. Canadian policymakers know they need to build their own parallel bypass lane for global trade, a kind of economic insurance policy. This isn't just about avoiding risk, it's about seizing an opportunity. As the world fragments and de-dollarizes, a vacuum is forming. Nations want alternatives to the dollar, but many are cautious about becoming too dependent on the Chinese yuan. Canada seems to be positioning the loonie as a potential third option, stable, reliable, and backed by a G7 economy, but without the geopolitical baggage. The strategy appears to have two main phases. Phase 1, which is happening right now, is about establishing the frameworks for trade diversification. This means negotiating new agreements and upgrading existing ones to create new pathways for Canadian goods and services. Phase 2 is the technological endgame, exploring how a wholesale central bank digital currency, or CBDC, could make future international transactions instantaneous and independent of the US-controlled financial plumbing. This is the big idea: to de-risk the Canadian economy, boost its financial sovereignty, and position itself as a key, stable player in a multipolar financial world. It's a pivot away from total dependence and toward a more balanced global footprint. And the evidence suggests it's already well underway. The genius of Canada's strategy lies in its distributed nature. It's not one big dramatic move. It's a web of bilateral arrangements, each tailored to a specific partner, that together create a more resilient trading ecosystem. Let's deconstruct this web. Partners 1 and 2. India and Indonesia, the demographic powerhouses. The pivot to Asia is arguably the most forward-looking part of this strategy, targeting demographic giants and future engines of global growth. With India, recent talks between the two governments aim to relaunch and finalize a Comprehensive Economic Partnership Agreement, CEPA. The goal is ambitious: to dramatically increase bilateral trade by the end of the decade by focusing on strategic sectors like technology, AI, and critical minerals. With Indonesia, the world's fourth most populous nation, a CEPA was signed in late 2025. This comprehensive deal eliminates tariffs on the vast majority of current Canadian exports, including agricultural products, wood, and industrial machinery, giving Canadian businesses a crucial edge in Southeast Asia's largest economy. By securing this direct trade relationship, Canada helps insulate its vital exports from potential disruptions elsewhere. Partner 3. The Indo-Pacific, the Gateway. Beyond single countries, Canada has a broader Indo-Pacific strategy. The goal is to supercharge non-US exports by strengthening ties across the region. This involves leveraging frameworks like the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, CPTPP, a trade bloc of 11 countries including Japan, Australia, Singapore, and Vietnam. Deepening these connections turns the Canadian dollar into a more viable trade currency in one of the planet's most dynamic economic zones. Partner 4. South America, the Bridge. Canada has also opened consultations to relaunch trade negotiations with the Mercosur bloc, which includes Brazil and Argentina. Brazil, a key BRICS member, is already making moves to de-dollarize its trade with other partners. By creating more direct trade channels, Canada can tap into this momentum in South America, positioning the loonie as a bridge currency between the G7 and the Global South. Partner 5. The European Union, the G7 counterpart. Finally, there's the European Union. Canada's CETA trade deal with the EU was a landmark agreement, but a lot of that trade is still settled in US dollars. A key part of Canada's diversification includes deepening the strategic partnership with the EU, especially in areas like clean tech and energy supply chains. Strengthening this transatlantic link creates a massive market less reliant on the American system, reducing transaction costs and currency risk for Canadian businesses. Together, these initiatives don't form a secret alliance, but a visible, resilient web. It's a system designed to replace a single point of failure, over-reliance on the US, with a diversified network of strategic partnerships. The new trade deals are the strategic what. The technology is the operational how. It's one thing to sign trade agreements. It's another to make them ruthlessly efficient. This is where the concept of a Canadian wholesale central bank digital currency, a digital loonie, comes into play. Now, let's be clear. The Bank of Canada has scaled back immediate work on a retail CBDC for you and me, citing a lack of public interest. But that's not the real story. The revolution isn't in retail, it's at the wholesale level. For years, the Bank of Canada has been a global leader in researching wholesale CBDCs, digital currencies designed for large transactions between financial institutions. Its Project Jasper successfully tested using this technology for high-value payments. More recently, in early March 2026, Canada piloted its first-ever tokenized bond settled with a wholesale CBDC, proving the technology works in the real world. A wholesale CBDC could unlock the full potential of this global trade diversification. Here's how. Instead of payments moving through a chain of intermediary banks, each taking time and a fee, a wholesale CBDC could allow for direct, simultaneous exchange. A trade between a Canadian and Indian firm could be settled nearly instantly on a shared digital ledger, completely bypassing the traditional US dollar-centric system. Another key piece of the puzzle is Canada's early adoption of ISO 2022. It sounds technical, but it's just a new global standard for financial messages that allows far more data to travel with a payment. By being a first mover, Canada is ensuring its payment systems can talk to the next generation of financial infrastructure being built around the world, including the digital currency systems of its trading partners. So while you won't have a digital loonie in your pocket tomorrow, the architectural work is undeniable. The research from wholesale CBDC projects and the adoption of ISO 2022 are the digital railways being laid for a new kind of global commerce. So, what does all this actually mean? What happens when a trusted U.S. ally starts building escape hatches from the dollar system? The implications are huge. For the United States, this is a quiet wake-up call. De-dollarization efforts by rivals can be dismissed. But when a close ally like Canada actively diversifies its trade and financial infrastructure, it signals that the risks of the dollar system, its weaponization and volatility, are starting to concern even America's friends. It creates a playbook that other nations can follow, slowly but surely diversifying the global financial landscape. For Canada, this pivot is a major step toward greater economic sovereignty. For decades, Canada's economy has been a ship tethered to the American supertanker. This diversification strategy starts to give Canada more of its own strategic autonomy. It could reduce import costs, attract new international investment, and provide a buffer against shocks from the U.S. economy, transforming Canada from just a policy taker into a stable, neutral hub in an uncertain world. For investors and individuals, this shift is already being felt. Some of Canada's largest pension funds have publicly stated they are rethinking their U.S. exposure due to geopolitical and policy uncertainty. While U.S. assets remain a massive part of their portfolios, the conversation has changed. The Investment Management Corporation of Ontario specifically noted that investors may need to reduce U.S. investments to seize opportunities in other regions. This creates a self-reinforcing cycle. As Canadian investment diversifies globally, it strengthens the very trade links that make the pivot possible. This isn't just a Canadian story. It is a playbook for every middle-power nation. It shows you don't have to be a superpower to carve out your own sphere of economic independence. By leveraging technology and building a network of partners, it's possible to navigate the 21st century economy on your own terms. So, has Canada really replaced the US dollar? No, of course not. There has been no dramatic overthrow of the financial order, but the evidence clearly shows that the groundwork for a more diversified, post-dollar world is being laid. The story is in the flurry of trade negotiations with countries like India and Indonesia. It's in the advanced research on a wholesale digital loonie. It's in the cautious statements from major pension funds looking to diversify their assets. Canada isn't declaring war on the dollar. It's building an arc. It's constructing a more resilient, independent financial network as an insurance policy against geopolitical storms and the weaponization of finance. This strategic diversification is a quiet, pragmatic, and potentially revolutionary act. It provides a blueprint for how a nation can assert its sovereignty not through conflict, but through innovation and partnership. The world is changing. The era of total US dollar dominance is evolving. What comes next is still being written. But with this quiet pivot, Canada has definitely started writing its own chapter. What do you think? Is Canada's strategic pivot a brilliant move for its future, or a risky bet against its most powerful ally? Let me know your thoughts in the comments below.